We now introduce the premise of comparison of ratios of companies. That's where ratios start making more sense. We had already discussed earlier that in itself, when you look at a ratio, that does not tell you too much about a company, right? But the moment you start comparing it with another company in the same industry, similar size, similar risk parameters, that's where the discussions start becoming interesting, and we start looking at more details about how companies are stacking up against each other, right? So we now begin our discussion on comparison of companies. We already have our company under question, which is eicher Motors, and we're probably going to compare it to another company called TVS Motors. Now, a couple of caveats here. Eicher Motors is into bikes and commercial vehicles. TVS Motors is largely into bikes and also three-wheelers, or I should say two-wheelers and three-wheelers. So it's not a very strict, correctly positioned comparison because they are sort of in different segments. Even within bikes, Eicher Motors especially works in the greater than 250 cc space, which is heavy duty bikes, and TVS Motors performs in the less than 150 or 200 cc space, which is the run of the mills bike. So some of the data points will come out because of that, but nevertheless, let's try and some of the data points will differ in these two companies because of that. But nevertheless, let's try and kind of anticipate and look at what these ratios look like, what these numbers look like for these two companies. So for this purpose, what we have done is we already have our numbers for eicher Motors. We have also calculated the same set of numbers for TVS Motors as well, right? So the same ratios over the last 3 years for TVS Motors have been calculated, and we have the numbers for TVS Motors stacked up here. For ease of understanding, what we are going to do is we are going to plug these numbers in together and put them on our PBD itself. So we're going to discuss this here, and we're going to write down whatever is important in this understanding of these two companies here itself, right? So without much ado, let's get into the discussion on how these numbers stack up. Uh, so the left side data is on eicher Motors, and this is for calendar year 2012, calendar year 13, calendar year 14, and these data points are for financial years. So for example, calendar year 2014 would be Jan to December 14, and FY15 would be April 14 to March 15. So practically there is a difference of 3 months in this data, but regardless of that, we do get a sense of what the data is, and we can start comparing this data when we look at these companies in detail, right? Let's look at some of the data points and start pointing out that data. So the first things first, for TVS Motors, we see stable margins, right? Stable margins on the operating front, but less profitable. Less profitable when compared to eicher than eicher, right? And why is that? Is possibly because eicher operates in heavy duty bikes, which may have a bigger margin, right? Whereas TVS operates in more run-of-the-mill 100 cc kind of bikes, and that may not have as much margin, right? Return on equity we see is kind of in the last year it's kind of similar for both the firms, but there hasn't been as big a jump for TVS as has been a jump across all the ratios for something like eicher Motors. Eicher does not have too much of debt in the final years, so effectively return on capital employed looks similar to return on equity, but TVS seems to have debt, right? And that's because why return on capital employed is different when you compare it to return on equity. Significantly different at that. That they would be different a little bit here or there, but significantly different when you see, right? This set here. Now, if you were to look at numbers of coverage ratios, right? If you look at coverage ratios, extremely comfortable for Eicher Motors. But in this particular case, this is improving, definitely, but was a concern in FY13, right? So what's happened is I think the debt scenario has improved over the years, but was a concern in FY13. That's improved. So essentially, there is an improvement, but nowhere close to the comfort level of the companies like Eicher Motors, and that is evident in the sense that Eicher has practically zero debt, right? Eicher has practically zero debt, but TVS has debt. TVS has a fair bit of debt, and the numbers were close to 1 times debt to equity here, went down drastically, and then have gone up again drastically. I wouldn't say drastically; it's an improvement from FY13, but they do have a lot of debt as compared to someone like Eicher, which is practically working at close to no debt scenario or negligible debt. That's why net debt to EBITDA is negative for these guys. Just in line with debt going down and debt going up again, we've had net debt to EBITDA also going down and going up again. So there hasn't been a significant improvement in the profitability of the firm. Regardless, there is a sort of stability in operating margins, and there's a slight improvement in net profitability. And I think this might be happening because we see an improvement here is possibly because of lower interest cost, right? And that's also evident in improving interest coverage ratio for the company. So all in all, Eicher looks better positioned than TVS Motors, but TVS Motors seems to be improving on its debt scenario in the last few years. Let's look at some of the other ratios. Current ratio for Eicher Motors shows adequate liquidity. You know, they have enough liquidity as compared to this. This is slightly less covered when you look at when you compare it to covered when compared to Eicher. Right now, that not necessarily is always bad. We do need to take into account how does this fit into the overall scheme, but primarily not as good as something like iShares. It may not always be bad, so we will look at this discussion on current ratio in more details when we reach working capital analysis. But at this point of time, it seems that Eicher Motors has adequate liquidity, but maybe at the same time, a company like TVS Motors doesn't have that, right? Then we look at some of the other numbers. Let's look at efficiency ratios. So inventory numbers look similar, just that I think Eicher turns the inventory slightly higher as compared to TVS Motors. So Eicher has higher inventory turns, right? Sales by inventory, remember, higher inventory turns, but TVS has less receivables, more receivable turns, right? That's why receivable turnover ratio is higher. So here TVS has less receivables. That's also evident possibly because Eicher is in commercial vehicles, right? So this receivable number is because it's in commercial vehicles as well. In the case of two-wheelers or bikes, you pay first and then get the bike. In the case of commercial vehicles, there could be some sort of a credit. The same data points also seem to be playing here, where TVS has higher fixed asset turnover ratio, possibly because of its presence only in fixed asset turnover ratio, possibly because it is only in two-wheelers and three-wheelers. You would need a higher capex for commercial vehicles, logically, right? So to that extent, your asset turnover ratios and fixed asset turnover ratios would appear to be better for TVS. In other words, TVS less asset intensive, right? That's what we are effectively zeroing down on, that to generate the same amount of sales, TVS needs lesser fixed assets and lesser total assets as well, right? Now, let's look at DuPont analysis. We see ROE was going up for both of these guys, but we see that for TVS, that's largely on account of the profitability improvement, right? Your gearing has gone down, your asset turnover is stable, profitability has gone up a bit, and that's resulted in the movement in ROE. In the case of Eicher Motors, gearing is almost flat. There is a marginal reduction in efficiency, and there's an uptick in the net profit margin, which has resulted in ROE going up. So ROE is driven for almost both the companies, primarily on the account of looking at what's happening with the profitability of the companies. So profitability seems to have improved for both the companies over this period, right? When you look at major costs as percentage of sales now, that's where some of the differentiation again comes in. We see excise duty movement has been similar, right? So movement in excise is similar. It seems the government has cut excise duty for auto segments around this period. So that's evident for both of the guys in a reduction here. Raw material cost bigger for TVS, right? So when we look at TVS, the raw material proportion is bigger for something like eicher, that's gone to about 56% of sales, whereas for TVS that's about 70%. And also your raw material cost is rising for TVS. It's actually falling for eicher, but that's rising for TVS. So something is going wrong there, which needs to be addressed by TVS Motors in order to take control of the situation. You also see other expenses are higher, right? Why is that so? Is because there is more advertisements that you see by TVS. That's because the market is more competitive. There are other players like Bajaj and Hero Motors in that market. You don't see as many ads by someone like Eicher Motors for that reason, and that's why you find that the numbers that you look at in terms of other expenses are slightly higher for a company like TVS Motors, right? That's the broad analysis we can do on both these companies. Both seem to be doing fine. Eicher slightly better positioned on account of terms like so let's actually zero down on where is Eicher better positioned and where is TVS better positioned. Let's first find out all the numbers where Eicher is well positioned, right? So we see that operating margin is where Eicher is better positioned. Net profit margin is where it is better positioned. Return on equity, return on capital employed seem to be improving more for Eicher's. Interest coverage ratio better position. Total debt to equity seemingly better positioned, right? Inventory turns better positioned. Current ratio better positioned. You'll see in terms of broadly cost of materials better positioned and other expenses also better positioned, right? So these are the terms where Eicher is better positioned. Now let's look at where is TVS better positioned. So receivables turnover, TVS seems to be better positioned. So that's TVS better positioning. Fixed asset turnover ratio, TVS seems to be better positioned. You see employee benefits and expenses, TVS seems to be better positioned. In almost all the other areas, Eicher seems to be better positioned. So there are some areas where TVS is better than Eicher, and that's by the nature of the business because TVS seems less asset intensive. Eicher is more capital intensive, and that's happening because of primarily its commercial vehicles division, right? So as we said, they're strictly not comparable exactly as 1:1, but for all practical purposes, that's a quick exercise in terms of trying and now making sense of ratios for two companies. When you do this for two companies, it becomes easier for us to kind of understand as to which company is doing better and which company is not doing better. In itself, now we have kind of calculated ratios for 3 years for two companies and then compared them across the years and trends. this becomes a more powerful analysis from our end, right? That's how you compare ratios. We'll do this across other companies as well, but that's it in this particular section.